All right, let's go ahead and kick this off. Thanks everybody for joining. My name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. Also joining me on the call is Peter Vito. He's our head of research and operations based out of Berlin. Today we're going to take an inside look at Nanalyze Premium. So the last free webinar we had, we looked at our investment methodology, and this week we're going to look at our premium offering. Now, rather than just make this a marketing call, we want to try to impart some knowledge as well. So we're going to go through the Nanalyze Premium offering. The price is going to be doubling in, let's see, 13 days. So it's rather a timely call. And we wanted to give everybody an overview of what that premium offering contains. Questions, if you can just hold your questions. We're going to post this presentation on YouTube afterwards. So we'll need a little bit of time to download and process it, but we'll get it up on YouTube. So if you post your questions there, we can answer them. It's likely whatever questions you have, other people have, so we can kill two birds with one stone. And of course, feedback is always welcomed on any of these presentations that we're giving. So today we're going to talk about our premium offering. It's something we built over the past year. The people that have helped us build it, our subscribers, have been a critical part of that. So everyone until the end of this year that's a subscriber is considered a founding member of Nanalyze. They'll always pay the same. But at the end of this year, we're going to double prices because we've put a lot of functionality into the offering, and we're going to talk about that. So this is the My Account page, and if you look here, you can see on the lower left, Nanalyze Premium Articles. If you subscribe as a monthly member, you can pay $15. You can immediately cancel, and you have access for a month, and you can read all 450 premium articles. We're producing about 3 to 4 premium pieces a week. So going forward, that's the incentive to remain a monthly subscriber, is you can continue to read those. That price isn't going to change. What is going to change is access to Nanalyze Premium Annual, and that's the rest of the components that you see on this page. So starting at the top, check out our portfolio. So we manage several portfolios, but the tech portfolio that we manage has about 35 tech stocks right now. You can very quickly see those by clicking on that banner. It'll pull up a page, and every month we refresh that with changes. And of course, our weightings are always changing, right? Or you may have a company that gets acquired, or all these corporate events may be happening. So every month we update that. It's a very quick way to see our portfolio and the corresponding weightings. Now, below that banner, you're going to see another banner called Investment Reports and Tools. And then we also have Nanalyze courses. Now, Nanalyze courses are just webinars that we hold for premium subscribers that get recorded and then posted here. But the piece that I want to talk about right now, investment reports and tools, we're going to start by talking about our flagship product, and that's the Nanalyze Disruptive Tech Portfolio Report. Again, something built per the requests of our subscribers. This report it's about an 80-page report, and it contains 3 types of stocks. We try to make things really simple. So if a stock we're holding in our portfolio, we refer to that as a love. So we love that stock. If there's a stock we're not holding, but we think investors ought to think about holding it, then that's considered a like. And then we also have stocks to avoid. Now, we have a whole lot more than 40 stocks to avoid, but the ones included in the report are ones that perhaps other pundits think are good stocks, but we disagree. So those will change as time goes on. This report, as a matter of fact, after this call, this will be the next thing that we're going to be working on, is the December update. So every month we update this report. We'll add stocks, we'll delete stocks, and we'll provide updates to existing stocks. And of course, our portfolio commentary, the one that I mentioned on the previous page, that's also included in the report as well. So that report is available for annual subscribers. And then the next flagship product, before we talk about that though, I want to talk about a portfolio a little bit. So we're managing our own portfolio. You all manage your own portfolios, and there are various things that come up that you need to think about. So for example, if you're managing a portfolio, what's the maximum number of stocks that you should hold? And we recently published a piece on this. Holding one stock, clearly we can understand that's putting all your eggs in one basket. But what's the ideal number of stocks to hold? Well, The academics believe that number is somewhere between 20 and 25 stocks, but our situation's a little different. So we have 12 categories that we cover, 11 tech, and we also cover cannabis. So if you take 12 and you multiply it by 3, that gives you 36. That's a pretty good number. And then if you add a 10% buffer, you're at 40. That's a nice round number. So we have a not to exceed. So we're holding 35 tech stocks right now, and we're not going to exceed 40. And that makes you start to think. Let's say you get up to 40, you have to think, all right, if I want to add this stock, I have to remove one. And it really makes you perform relative comparisons in the stocks that you're holding, and it makes you think about the exposure that you're getting. So that's a rule that we set in place. Adding a 20% under cost basis. So the way that we'll add a stock is not to just go out and buy it. You don't, a lot of people want to know when should I buy it? Is this a good time to buy? Best way to buy a stock, first figure out the target percentage that you want. Okay, so if you're holding 30 stocks, and that's an equally weighted portfolio, 1 divided by 30 gives you 3.33%. That's your target position size. So what we'll do in that example, we'll add, let's say, 1%, so about a third of the desired position size. And then we'll slowly keep nibbling. Now, if the stock price keeps going up, then our weighting's increasing anyway. But if the stock price starts going down, once it gets 20% below our cost basis, we'll start adding. All right. So we don't just enter a stock and put all our money right into it. We slowly add over time. And right now in the market is a great example of why you want to approach things very slowly, because tech stocks are very volatile. We probably have 4 or 5 more positions down 20% right now, some down 30, some down 40. You want to have dry powder because that stock that you bought that's down 40%, it's a quality company, right? People always get concerned about a stock dropping. You should be excited because you're able to add a stock on sale, right? So historically, we focused on one stock a week. If we have a stock that's 20% below our cost basis, we'll add to it. Well, right now things are kind of crazy in the market, as you know, so we're adding more than one name at the moment. We're using some of our dry powder. Cash. How much cash should you hold? Well, historically, we've held between 20 to 22% of our tech portfolio remains in cash. I looked yesterday, I think it's around 18%. So we've been putting some of that money to work. Limits on categories. So as I said, we have 12 categories. For example, life sciences, we have, I think, 6 holdings there. Should there be a limit? Well, probably not, because it just depends. You have AI has a lot of opportunities and a lot of stocks going on, right? But space, not so much. That's still a pretty emerging area and it's very high risk. So we want to be thinking about these things, but they kind of work themselves out. Now, the reason that we publish this portfolio is to provide insights. We don't give people directives, and we look at our subscriber base. We've looked at paid and non-paid. About half first-time investors, all right? Other half experienced. And of those, a good chunk are institutional investors. And we talk to them, and they don't sit and do what we do. They simply take insights based on what we're doing and learn from the mistakes or the successes that we have. And that's how we set things up with our subscription offering, is to teach people. We're not financial advisors. We want to teach people to be better investors. So that's something to think about there. The other product that we have that complements the report is the stock catalog. All right, this was put together based on, again, feedback from our subscribers. We have about 370 stocks in this catalog, and here I've just taken a little snippet. So you can see these are the fields, some of the fields in the catalog. It's an Excel file. You can see category, subcategory. Remember I talked about loving? Well, these are actually stocks we love. That means we're holding these stocks with real money. Now, you'll notice Blue Prism on there. Well, we actually sold Blue Prism when they were acquired, or they've yet to be required. It's a complicated story, but that we're no longer holding that position. You can see here where we've noted if a stock trades on a foreign exchange, and there's about 70 stocks in that catalog that trade on a foreign exchange, which is great because then you can get foreign exposure, right? That helps diversify your portfolio. We've covered about 70 SPACs, and if you look to the right there, you see the little column. That's really slick. You can just choose yes there, and it'll filter all 70 SPACs. Then you can sort on price. And because all SPACs priced at $10 a share, very quick to see which ones are gaining and which ones are losing, because it's interesting. And then we also have about 22 ETFs in the catalog. So these are the initial fields. And then we also have some other pretty cool stuff. So um, moving to the right, we have notes, and that's just 2 or 3 sentences that talk about how we feel about that stock, whether we love, like, or avoid it, what our basic thoughts are very quickly, an elevator pitch, if you will, in 5 seconds. Then we have the latest article date, so you can see the latest research that we've published. And then on the bottom here, this is really cool stuff. So there's a tech or financial data firm called Refinitive. And if you have the latest version of Excel, you can do this yourself. And this is very cool. And I've put the link to an article where we tell you how to do this if it's something that you'd like to do. Let's say you have put your portfolio in Excel. What you can do is select the names of all the companies and it'll resolve them. And then you can start populating data and you can do it automatically. So for example, price. We simply click refresh and it'll automatically update the price for all 370 assets on the fly. Same thing with market cap, same thing with currency. And you can see on the right, the bottom right here, there's a whole slew of fields and it works really well. And this was, again, something a subscriber had asked for. And we were looking for it ourselves and we ended up finding that this was the best solution. And if you have the latest version of Excel, take a look in there. You should be able to use this yourself. And again, that article at the bottom there will tell you how to do it. So that's also a feature of our stock catalog. And then we have some data that's specific to our own methodology. When we look at valuation, right, we want to keep things really simple. Everything we do, we want to keep things very simple. There's no reason to make things complicated. And financial people love to do that. We use what's called a simple valuation ratio. Market cap, we can all understand that's easy to get from Yahoo Finance or wherever you pull your quotes, divided by annualized revenues. And we say annualized. What we mean by that is take the last earnings report. So if they report quarterly, then you multiply it by 4. If they report every, twice a year, then you multiply it by 2. That annualizes the revenues. And you take market cap and you divide it by that number. It's very simple. 2 clicks on Yahoo Finance, and it gives you a number. What do we do with that number? Well, we have a rule that says we don't invest in a stock that has a simple valuation ratio greater than 40, period. I don't care how great the story is. And people say, well, maybe you won't get into a stock. Well, we've been testing this for a while and it works pretty darn well. One example here is UiPath. So when UiPath debuted, we really like UiPath, but it was too rich. So we're not going to buy it. We're not going to buy it. Well, look where UiPath is today relative to their IPO. C3 is another example. C3, another company we love, actually. C3 was trading at $90 a share when it IPO. Today it's at 30. So when you have an objective rule that keeps you from getting into something that's overvalued, it works very well. And maybe you can set that number to whatever you like, but we found 40 is a nice round number. So we're automatically calculating those valuation ratios in there based on the data points. Now we manually input last quarter data. You see that field and last quarter revenue. We're manually inputting that ourselves. So these are data points that are specific to us, but they're simply using the market cap. And then we have our average purchase price and gain loss. And again, these are older numbers, but that very quickly lets us see where we're sitting at with our position. So these are all the data points in the catalog. It's very useful. And the other thing that people had wanted that we've put into place are a series of alerts. So we alert you when there's a new article, and annual and monthly subscribers can get this because that's how we have it set up. Product update alerts. So in 2 days or 3 days, when we update a report in catalog, those are ready for you to download. We'll send out an alert, and then you can download those and see the changed, updated versions. And trade alerts. So how this works, we don't, they say it's all about time in the market, not timing the market. So when we decide to enter a new position, or we decide to exit a position, or perhaps we decide to start accumulating a position we're already holding, we'll send out an alert and let Nanalyze Premium annual subscribers know. We send these alerts right after we make the trades ourselves, go right to the brokerage account, make the trades, and then we'll send the alert. So these are, again, features that were requested by our subscribers. Now, we also have a number of reports here that you see, AI healthcare and machine vision. These are really good reports. We put a lot of energy, time, and money into these, and they're very nice reports, but they're deprecated. So they're 2020, which means I think they're mid 2020, so they're already a year and a half old. We're not going to be updating these. This is the direction that we originally decided to take the subscription offering, and then based on all the feedback received, we decided, listen, these reports, they're still value, they're still useful, but they're not something that we're going to keep updated. So they're available to you. You can download them as an annual subscriber, but they're not going to be, over time, they become less and less relevant. Now, the other thing that I wanted to share with you, which is very cool, is a strategy that myself and Peter had built in when we were doing time in the financial institutions of America. We built this strategy called Quantigence, and this is something that we make available to Nanalyze Premium subscribers, the annual subscribers. This is a strategy that involves dividend growth investing. Dividend growth investing is about companies that not only pay dividends, but increase them over time. And this is very powerful to think about. So when we were looking at, retiring and things like that, there's a big flaw in everybody's strategy. And it goes like this. Let's say you retire when you're 60 and you've got another 30 years to live. If you're getting a fixed income, let's say a pension, or let's say fixed income, a fixed amount of money every month. In 30 years, your purchasing power halves. That's a huge problem. When I'm old, I don't want my quality of life getting worse every year that passes. How about it gets better every year that passes? And that's what we came up with, dividend growth investing. So a dividend champion is a stock that's not only paid, but increased a dividend for at least 25 years in a row. I was looking the other day at J&J. Over 50 years in a row, they've been increasing their dividends. That's an incredible track record, and they're highly unlikely to break that. So this is a strategy we built, Quantigence. It's a quantitative way to select dividend growth stocks so that you can build your own portfolio. In the report that we provide you, we're showing you the step-by-step how we built our own portfolio, and you can, of course, do that however you want. Now, when you take a holistic look at all your assets, which everybody should do, even the finance world calls that, assets under management. Right? This is all the money that you control, that you're investing. And you can kind of think of it like we're all a family office. We're a family office, you're a family office. You have your family and you have your assets and you have to invest them. So this is how when a family office or a money manager looks at their assets and they're a multi-asset class manager, this is the biggest and most important decision, one of them, that you have to make. What asset classes are you going to allocate your assets to? So you can see that over half of our money is in our Quantigence strategy. So people, I think, when they see Nanalyze and the tech stock bits in our tech stock portfolio, they don't realize that's just one component of our overall asset allocation strategy. Most of our money is in Quantigence. 22% of our money roughly is in our tech stock strategy. And again, some of that is in cash, as I said, 18%. Then we have some funds. This helps get rid of domestic bias. Europe funds, Asia funds. We have some cash that's separate from the cash in the tech portfolio. And then in yellow here, you can see what they refer to as alternative asset classes. We have some wine. That's actually a very fun investment, right? That's with Vinovest. We have art. That's with Masterworks. And we've worked closely with both of those firms, the founders, and really we believe in those platforms. They're quite good. And we have some Bitcoin. We're largely bearish on everything crypto, Web 3.0, creator economy rubbish, but and there's some there, but we're largely bearish on that. But we're long Bitcoin just based on ARK's thesis. Long story short, and then some gold. So when we're thinking about where we put our assets, this is how we've allocated them, and everybody ought to think about how they're allocating their assets. Now, going back very quickly to the Quantigence strategy, this is kind of how it works. So for every dividend growth stock, we start with a universe of 70 stocks, and every one of these has increased their dividend at least 25 years in a row. That's how you get in the door. That's how you qualify. All right. And we have 70 companies. All right. Which ones do we pick for our portfolio, which holds 30 stocks at the moment? Well, we build what's called a Q score. These are various factors that are used to produce a Q score for every stock. So the first one is years increasing. For every additional year that the company has increased their dividend, they're rewarded. They're given a higher score. Then there's market cap component. Bigger is better, right? Bigger is always better because that's how it works. The smaller a company is, the more risk it is. Yield. This one's tricky. Higher is not always better. And a good example of that would be AT&T and Exxon. All right. They have very high yields. Why? Because investors need to be rewarded because they're worried those companies might not be able to continue increasing dividends. Exxon's come real close to not being able to increase that dividend. So has Chevron. Look at Chevron's investor deck. I remember in the last oil crisis, the first slide said, our dividend is the single most important thing that we're protecting, the increase of that dividend, because they don't want to lose their track record. So that one's tricky. We want to reward yield. We want to say penalize low yield, but not reward high yield too much. So this is all in the way that these factors are calculated. Payout ratio, that's the money left over when a company has their earnings and they pay dividends out. That's the money left over. That buffer helps them continue to increase that dividend even if their earnings are falling. Then we have international sales. So we want to avoid domestic bias, and 5-year and 10-year dividend growth. These come into play here to put together that Q score. So this strategy in our next presentation that we're going to do, our next free presentation, free webinar, probably next year, early next year, we're going to take a closer look at this. But I just wanted to kind of give everybody an idea of that strategy, and that's another bonus. And what's kind of cool, as I said, we want to give you something, is that you can actually go and we have a website where you can play around with it. So here's an example in consumer discretionary. You have McDonald's, Lowe's, VFC, Target, GPC. McDonald's, excellent company. And you can see how the Q scores are calculated here, and the McDonald's ranks highest. And what you can do if you go to Quantigence.com is you can go play around with that. We've built this into a calculator, and you can take a look at the universe of dividend growth stocks, and you can play around with that and kind of see how we've ranked them. So that's also there's other information there, our guide to dividend growth investing and other bits. So you can check that out yourselves. Just go to quantigence.com. It's all free. That's something that we're building out, and eventually that will move to being paid. But for right now, that's free. So have a look at it and see what you think. Wanted to talk about Nanalyze Pricing. So as I said, founding members before the end of this year, anybody who is on board is a founding member. And that's why we wanted to let you know before the prices increase, this is the chance to get in before they double at the end of the year. And we talked to a lot of our members that we have to date, and they've really helped us build things. And we plan to continue to do that going forward. So I wanted to talk a little bit about pricing. We've done a lot of work kind of figuring out what the optimal price point should be. 119.99. Well, if you have 1,000 subs and you're getting $119,000 from that, that's not a lot of money. An analyst, let's say a good entry level analyst, is going to be 6 figures. That's just how it works. So the price point that we're at right now, relative to other subscription offerings and based on what our subscribers tell us, and you can check out our testimonials page. Probably one of the most encouraging things are all the compliments that we get from people, aside from them opening their wallets. The price point just isn't matching the value. So that's why we've decided to do something very simple, say double it. That's a very simple price increase, is to double things. So starting at the end of this or the beginning of next year, we're doubling it. If you even doubled at 1,000 subs, $240,000, what are you going to do with that? Well, now you can perhaps get 2 analysts, and then the leftover can help pay the cost of doing business. So we have our hosting, image licensing, the email provider we use to send out these email blasts and alerts, the conferencing software we're using right now, et cetera, et cetera. So there's a lot of costs associated with what we do. That's why we want to make sure we find that optimal price point to price our product. And we believe that $239.99 a year is where that should be, based on the work that we've done, and of course the work we continue to do. We don't just sit on our laurels. We're always improving our product, and that's how you get people to renew. We have a very high renewal rate because we're constantly adding value and listening to what our subscribers say. Plans going forward. Well, we're going to catch up kind of from an editorial direction. We're going to catch up on covering SaaS IPOs, which we've largely done now. Continue covering relevant SPACs. There's been 990 IPOs this year. Incredible, right? That many IPOs. It's actually the 2 biggest years in the .com era. We've already exceeded those in 1 year today. So that's 990 IPOs. There are a lot of companies that are having IPOs and SPACs that are relevant to the tech categories we cover, and that's why we're having to cover a lot of SPACs. Once that music stops and all the companies and all the money dries up, and we're going to focus more on covering stocks that we're holding. And typically we check in about, let's say, once a year with a stock unless something happens, because when we invest in a stock, it's for the long term. It's with a decade long time horizon. So we'll move our coverage more to focusing on stocks we're holding. We'll look at adding additional fields to our catalog. We're building out Quantigence, so we're building out that strategy as well, because as I said earlier, you can't just have all your eggs in one basket. 22% allocation to tech stocks, that's actually quite high, and that's because we're very bullish on tech. So we also need to have a supplementary strategy that we can offer, and that's what Quantigence is. And we're building that out. And then future plans, we've been looking at possibly having ETFs, because we have two portfolios now and we're making them more quantitative. And we've had some talks with ETF providers. That's a little more difficult than it sounds, but that's something that we're going to be looking at. And China, I've spent the last decade in working very close proximity to China, and it's a very exciting place, but at the same time very scary. And I think anybody who's been an investor in Alibaba is going to kind of know what we're talking about there with VI structures and what's going on right now. So China is another area that we think we'd like to dabble in a little bit more, and that's separate from tech stocks and also separate from our dividend growth investing strategy. And then last, I just wanted to talk about the intangibles. So the other thing people mention that they really appreciate is our accessibility. And myself and Peter are talking to our subscribers all the time. We're always accessible, and people don't take advantage of that. They're actually very nice, and they really appreciate that. And I think that's very important, that accessibility and authenticity. So we're always accessible. Any email we send you, you can click reply and ask us questions. You can do that after this call if you like. We always listen to people paying the bills. As I said, that's very important, and we don't take ourselves too seriously. I think probably the second or third thing that we hear the most from people that read is that they really appreciate the kind of the sass or the irreverence, and that's because we have fun with it. Finance is a dreadfully boring industry to work in and to be a part of. It's horrible. And if you can have some fun with it, it just makes it so much more interesting, because a lot of this stuff can be really dry. So we really have a lot of fun, and I think it shows in the products we produce and the content we produce, and we don't see that changing going forward. So these are kind of the intangibles, what makes us different, and kind of our ethos or our culture, and that's kind of defined Nanalyze over the years. So I said questions here. If you wouldn't mind, just you can fire us an email if you'd like after this. We're going to get this up on YouTube probably in the next hour. We'll send out an alert to everybody once that's done. You can go pull that video up. Check out our YouTube channels. We're now pushing out content on YouTube. That's early days. We've been having some growing pains, but we're getting those sorted out. We're pushing out some good content on YouTube. And we're going to be further expanding that channel. So this will be up there. Please post your questions. Thanks, everybody, for taking the time. Do consider what we've talked about today in terms of you've got 13 days sort of thing. It's probably going to be 15 days, because as I was saying, we're probably going to be pretty hungover on the New Year's Day. So the change probably won't happen for a couple days, but we're going to be changing that price point. So make sure you take advantage of that if you'd like. Thanks again for your time, and we'll look forward to talking. As I said, next free webinar, we'll tell you in the newsletter, is going to be on Quantigence. So thanks again. We'll talk to you later.